Wagwan people, don't know, my name is Sean, and in this video we're going to talk about how to manage risk when investing.
Let us talk some business. Let us talk some business.
So what is risk? Risk is basically the potential to lose money. So as an investor, you want to invest in stock or you want to open a business, the potential that you will lose money, that is called a risk. A very good friend of mine inspired me to do this video, and that is because a lot of people are getting into the stock market and they're opening businesses and they're caught up on the profitability of these things. However, there is another side where you could lose all your money that you invest. Now, the ultimate risk is to lose all your money on the stock market, or if you open a business, the business closed down. That is the ultimate risk you face when you engage in any business related activity. So you got to take steps to cover yourself in the case these things happen. And in this video we're going to explore three main criterias or three main points, methods of how you could save yourself from experiencing significant risk. The first method I would like to talk about is research. Research is an effective tool used to mitigate your risk. When you research a company, you know about the profitability, you know how likely it is that the company will go out of business, you know about new business deals. You get all these types of information to make an informed decision. So how you research a company, it's simple. Whatever stock you're going to buy, you type that stock in Google, you find a company that issued that stock. Now to research a company, you go on Google, is this company profitable? You get a bunch of news articles, information from the company. You read them, get an understanding of where the company is at. If you don't like what you see, don't invest. If you like what you see, you invest cautiously. That way, you'll have a better understanding of what is going on with the company, and you have that confidence in your heart knowing that the company is likely to succeed and you'll be able to gain dividends. So in my opinion, that's the first and one of the most important methods in mitigating your risk when investing. The second method in mitigating the risk when investing is to never put all your eggs in one basket. And to simplify further, this means you don't put all your money in one stock. You split your money over several stocks. So let's say, for example, you split your money to 10 stocks. If the price of 3 stocks go down, the price of 3 stocks might be up, right? And the other 4 stocks is doing consolidation. So that means you still have a profit in your portfolio. Sometimes you could have 6 stocks going down, 4 stocks going up, and the 4 stocks that are going up outweighs the ones that are going down, and you're still in profits. So you splitting your money across several stocks increases your likelihood of profitability over a period of time. And in general, stocks do rise and fall. As I said in my previous video, the price never stays static. It always goes up and down. But if you diversify your portfolio, you split your money to several stocks, it's almost guaranteed that your portfolio will increase and not decrease drastically. So that's another important method of how to reduce your risk when investing. The last method I want to talk about is very important, and a lot of people do this. When you have your money for bills, for example, your rent money, for a light bill, gas bill, and then you take that money You put it in stocks, hoping that it's going to increase in value, and you take it out in time to pay that bill. That is very risky. And I suggest you stop doing it because it's going to catch up to you. Some people get lucky, but that is not a good way to do it. Avoid using money that you have set aside for bills. Avoid putting that money on the stock market, because the stock market can be a very mean place. It can be scary at times, and it can be very shocking. You could be right on the money, and you know a certain amount of stock is going to increase, and you take your rent money, buy stocks with that, and then another news come out about that stock, cause the stock to go the opposite way. By the time you're to sell that stock, you're probably $500 in negative, so you lose $500, and then you're $500 short on your rent or light bill or gas bill. So I highly recommend, do not touch money that is set aside for bills. Only invest with money you could afford to lose. Bear that in mind. Only invest money you could afford to lose. So if you're really serious about investing, if you follow these 3 steps that I just explained, it's 3 methods rather, of you gotta do proper research, diversify your portfolio, and avoid using money set aside for bills to put in the stock market. If you follow those 3 methods, you're on the right track. And I strongly urge everyone to do thorough research. Above all, research. You can't just jump into the stock market not knowing what you're getting into. You should go in there with your eyes wide open. Whatever company you're going to invest in, researching the company is the most important thing you could do for yourself and for your money. I hope you guys enjoyed this video. I just want to make sure you understand what you're getting yourself into if you decide to invest. Please remember to like, share, subscribe. I appreciate you guys. Thank you.